Good afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer Readings webcast. Joining me today, as always, is our Chief Investment Strategist and President at Barometer Capital, David Burrows. And on today's webcast, we will provide you with a brief macro overview and, of course, open the conversation up to your questions after David has completed his review. We'll speak about market volatility and where we think the market is headed. So I'll turn that conversation over to David. If you have Q&A, please don't hesitate to hit me up on the Zoom link or by email phastings@barometercapital.ca. And with that, on this beautiful sunny afternoon in Toronto, I turn the conversation over to the one and only David Burrows. Good afternoon, David.
Hey, Pamela, how are you?
Great, thank you so much. Looking forward to your presentation.
Well, not only is it a nice day outside, but it was a good day in the market today. Market S&P up over a little over 3%. Two back-to-back strong days. These things happen when you least expect them, or when everybody leans to one side of the boat, which is why we have to stay objective. It's why we have to not make big binary decisions and take things step by step. So we've got lots to talk about today. So why don't we kick off? To start off with, as we have said for quite some time, we continue to believe we are in a structural bull market in stocks that started in 2013. Because we're in a structural bull market in stocks does not mean the same stocks do well all the time, does not mean the same sectors do well all the time, but it does mean that we have in general had a structural tailwind where valuations have been elevating over the last number of years. And certainly this year, valuations have come in. We've been through, pretty sizable bear market, but they happen in bull markets, but they tend to be over fairly quickly. And it remains to be seen whether this will prove out to be just another bull market, significant correction or not. But we'll talk about that as we go on through the presentation. So this is a picture of the S&P going back to the early 1980s. You can see that, as is typical in a structural bull market, the green line is a long-term 200-week moving average. And the market does pull back and have corrections, but tends to have an ability to stay above that long-term moving average. We get into a structural bear market like we did in 2000. We spent years crisscrossing back and forth this more or less flatlining long-term moving average. We got above it in 2011. We broke out to new highs in 2013. And since then, 116 months, market has had a pretty good go, despite the fact that we've had a difficult year this year. But as you can see, we've pulled right back into this rising 200-week moving average. And at this point, the market continues to stay above. We briefly dipped below in the 2020 COVID bear market, which was very rapid. It happened over really 2 months. And then the market rocketed on to new highs. The reason that we don't want to make binary decisions is it may be that we will exit this bull market and enter longer term consolidation. It's not impossible. But if we don't, what you give up the 2 years that follow structural bull market corrections can be sizable. And similarly, if we were to break down, we can continue to get more defensive than we are already. And we certainly have cash in portfolios on positions that haven't worked out or sectors that have given us reason to stay on the sidelines. But this is a step-by-step process. When we look at it another way, the S&P has managed to stay within this channel since 2009. And again, a brief dip below the channel line as of last week. We've come out swinging in the beginning of October. It's hard for people to remember, but despite the fact that you often have some bad days in October, October is about the best month of the year historically, because we tend to come in weak and exit strong. You're coming into the third quarter earnings report. In years where analysts have been too aggressive, they tend to be cutting estimates quite dramatically coming into the third quarter earnings period. To my knowledge, the estimate revisions actually have been pretty benign so far coming in. And of course, one of the concerns is the Fed's tightening cycle will cause a hard landing in the economy. So this has been a major reason why stocks have pulled back. Certainly the higher rates have also contributed. When we look at the S&P, this was the S&P as of a few weeks ago after we rallied off the June lows. We talked about the fact it was likely, having been stretched significantly above the 50-day moving average, that we would pull back in the seasonally difficult period. And here we are into the beginning of October, and markets certainly did pull back. And they pulled back to test this rising 200-week moving average. Now, what you may not have seen is that the last 2 days have been very, very strong. We've had a strong bounce. To put it in a graphical sense, this was the S&P 500 yesterday. You have to look pretty hard to find red dots or companies that were down in the day. We followed it up today with a plus 3% day. These are significant days. A first day of a rally may well just be short covering. And certainly when the market has been weak and positioning is very defensive and people have short positions or hedges, an up day forces people into the market. From a technician's standpoint, what I like to see is, yes, have an up day, but within the next 4 to 5 days, have another 2 to 3% day, which we call a follow-through day. And a follow-through day means it's not just a one-day wonder, it's something that's more significant. And what we care about is the breadth of the advance. What percent of stocks in the index participated? Well, you can probably answer the question for yourself. Pretty broad-based rally, pretty good volume, a pretty good start. So 2 days do not make a trend. 2 days do not make a bottom. But we're going to walk through the steps and take a look at some of the key themes and see how they're hanging in. And we can make some assessment as we go along. But the last day, the S&P gained 2%, 2 days in a row, coming off a 52-week low, was November of 2008, which is not that heartening. 2 times it happened in 2008 fall, November and in September. We know that in December of that year, after actually a pretty significant rally, the market did fail and go on to make lower lows in March of 2009. So 2 good days does not make a conclusion. But when you look prior to that, other times that this happened, it absolutely nailed the lows in October of 1990. That was as we were heading into the 1990-91 recession. We had 10 great years in the market following that. And in October of 2002, which was really later on in the tech wreck, and then December of 1987 after the 1987 crash. So we don't have an answer yet, but certainly it gives things to think about. So other clues that I look at, this is the VIX, or the Volatility Index. It looks at the fact that we made on 4 days ago, VIX went to the same high we got to in June of this year, still pretty substantially below the highs that we saw earlier in the year, and not a substantial spike, not anywhere close to what we saw back in either the COVID bear market, very different picture, or the great financial crisis in 2009. It's not to say these things can't happen, but they aren't happening at this point. And so we always continue to watch for signs that things are getting worse. And one of the first things I would look for is for us to take out one of these previous highs in volatility from early in the year. Not the case so far. In fact, so far this week, volatility is down about 8%. Now, we've made the case for a long time that we saw a structural bottoming in interest rates in 2020. There have been 3 really bad bear markets over the last sort of 125 years. You had a bear market that lasted from 1899 to 1920, and that was a significant bond bear market. There was a rise in inflation, and during that period of time, bond yields went higher, bond prices went significantly lower. The next great bear market started in the end of the 1940s, and it went on to 1981. During this period of time, bonds gave a 0% rate of return on a real basis. In other words, when you netted out inflation, there was nothing left. That's why I get concerned about a shift in interest rate policy. It means that the one investment that people thought was the safest, most conservative investments over the last 40 years just is not working. We've been through a terrible bear market, and this is probably the beginning. Now, it's not to say that they go straight higher. You can see that there were lots of retracements in yields along the way. Every cycle, though, every economic cycle saw a higher and higher terminal rate for interest rates along the way. We may well have seen the high for the near-term picture in rates, but clearly something has changed. As of last week, we were touching on 4% in the 10-year yield. As of this afternoon, we're at 3.62. Now, markets hate two things. They hate when big asset classes move in a hurry and don't give investors time to adjust. And that's what we've seen in this bond bear market. Bond yields went sharply higher across the curve from 2 years to 30 years. And there are billions and billions and billions of dollars of derivatives that are attached to those bond yields. Many pension funds stepped aside from owning bonds and in fact bought swaps on interest rates to give them the exposure they wanted without having to put up the capital. They could use the capital to invest in other things. When we had such a sharp move higher in interest rates, first in the UK, it put pressure on pension funds who had to add additional collateral to continue to carry their position. That forced them to sell other assets like stocks or commodities or real estate. This is part of the reason we've seen such pressure over the last month. Now, we did see a pullback in yields over the last 5 days from 4% to 3.6. That helped take pressure off the market. The other major asset that was changing in price rapidly was currency, US dollar. And the US dollar moved from 88 versus the basket of world currencies, which is pound, euro, and yen primarily. And again, when the dollar strengthens so dramatically, again, it puts pressure on some of those derivative baskets that investors may have exposure to, large investors. So this has been a very difficult year for investors. Not only is the stock market down at the lows, 23% on the S&P, 31% on the NASDAQ, but we've had one of the worst bear markets in bonds in history, which means if you had 60% of your portfolio in the S&P 500 and 40% of your portfolio in a 10-year treasury bond, as of the end of the quarter, you were down 21%. So if you go back over time, you are hard pressed to find another time where the 60-40 portfolio was so poor. The last time was in 1931. It's a long time ago. So this is why it's been so difficult for investors, because they were losing money on both sides. Now, fortunately for us, we recognized the shift in interest rates. We stepped away from the bond market. And in fact, we're short the bond market for much of this last 18 months. As we said today, we do have some short-term treasuries, but we're using them just as a safe asset or a place to hold cash until we deploy it. But make no mistake, it's been a very difficult period for bond investors. The TLT ETF off the high in April of 2020, down 43% as of the end of last week. Now, it's interesting to me that despite the fact that bond prices have been coming off, every time they dipped, institutional investors bought more. In fact, we had record inflows into fixed income ETFs this year in a falling market. The reason I think that that's important is that over time, I think that some of that money is going to have to come back out because it's been a disappointing investment and there are other things to do. But it tells you that old habits die hard. And over the last 30 years, every time the bond market pulled back, it paid to buy the dip. This may be that one time that it doesn't. And it reminds me a lot of what happened in tech stocks after the year 2000. But we do have some news that is getting better for bond investors that will take the pressure off the Fed to continue to ratchet rates higher. The two things they want to do is they want to keep employment firm, but more importantly, they want to see inflation come down. When we look at the ISM manufacturer PMI data, you can see that it is weakening. So this is made up of supplier deliveries, inventories, employment, production, new orders, and ISM manufacturing, all of which have been coming down. When we look at the prices paid that purchasing managers level, it also is coming down. When we look at shipping rates have come back to 2021 levels. We heard all kinds of data around what it was costing to ship freight in a container from Asia to the US. And the ISM Manufacturing Index prices paid data is important to follow because it tends to lead what happens in CPI. When you go back to 1980, we had a rollover in the ISM manufacturing data, and a few months later, we had a rollover in CPI. So we may be seeing the beginning of a rollover in CPI, but it's being preceded by a rollover in the ISM Manufacturing Index prices paid data. Same thing happened going back to the early 1970s. These are good things. It means we may be moving along the path that the Fed wants to move along. Other signs of inflation. Crude oil pricing down about 40% from the March highs. Used car prices are down 13% year to date. Even rents are down. It was the first decline of the year and the increase at the lowest level since May of 2021. Let's talk about employment. Yes, the employment data has been strong, but the job openings starting to come down. When we get to the commodities, we talked about commodities over the last number of months, where we talked about the fact that the relative price performance of commodities versus stocks looked like it was reversing a very long decline. We clearly had a reversal in that in the RJI index, which is an equally weighted basket of commodities, and certainly had been pulling back, and this past week started to rally again. The relative price strength of the RJI index continues to be very strong. Why? There's a structural deficit. Now, the obvious trade, if you thought that the Fed was going to choke off growth, would be to bet against things that are economically sensitive. So why is it that commodity prices are staying fairly resilient? Well, I think the big reason is we've been through a bear market in commodities, and the CapEx cycle really hasn't gotten going. In other words, over the last number of years, especially from 2013 to present, the amount of money spent on capital equipment and expanding capacity has fallen and fallen and fallen relative to GDP. And we are at the lowest point in the CapEx cycle going back to 2013. That means that even with a weaker economy, there still is growth in demand for basic materials from different parts of the world. It means we have a structural deficit. So when we look at the RJI index on a short-term basis since the beginning of the year, the relative price strength versus the S&P has been pretty relentless. If you take just this basic index and compare it to the S&P 500, it's trading better than 88% of the stocks in the index and continues to be very resilient. When we look at the underlying pieces, oil briefly dipped below the 200-day moving average. As of today, back above, trading better than 91% of companies in the S&P, and on the year, up 38%. Let's look at other areas of the commodity complex. This very long bear market that took place in base metals broke out and pulled back to the long-term rising moving averages, where we found support both in June and September. We've had a very sharp rally this week, and the producers rallying with them. Even gold, which has underperformed over a period of time, has pulled back to the long-term moving average, held, and had a sharp move higher. Silver, the same. Two very good days on back-to-back in the precious metal space. So both of these finding support, metals, oil, and precious metals, all of them things that you might expect to weaken if we have a hard landing. It doesn't look to me at this point like market setting up for hard landing. Across the commodity complex, agriculture continues to be the strongest, energy second, precious metals third, industrial metals fourth. Real estate, the fourth asset class. Clearly, it is weakening. This is the group that gets hurt most by rising rates. And they're performing, as you might expect, down almost 30% on the year for the average REIT. So look, we have to find the buckets that are stronger on a relative basis, those that have a strong structural backdrop, And we need to focus in those areas that have a tailwind. We don't have to be everywhere. So we want to focus on market leadership. We're going to talk a little bit about that as we go through. We're always looking for new leadership to emerge. And in the absence of leadership, well, it's okay to hold some cash. We're trying to have a tactical approach here. We use our top-down work, trying to find parts of the market that are seeing net inflows of capital, where other people already care. We're trying to use our analytic capabilities to identify specific securities within those groups that meet our fundamental tests and that are technically sound. In other words, we're not the only ones that believe they're fundamentally sound. And our portfolio lives in this space. Strong leadership themes in the market expressed using strong securities that meet our tests. And then we have to continually test this basket of holdings to say, do they continue to behave the way that they should, given what we think we know? And if they don't, we use our stop losses to exit, which means our portfolio is a living, breathing thing. We're always looking for areas of the market that are showing expanding breadth, meaning more and more securities are participating in a bull market. And we try to avoid any groups where the percent of stocks in uptrends is deteriorating. It's just an ongoing process that we follow. So let's talk leadership. As of a week ago, all of our indicators were negative, but we highlighted the fact that they were becoming exceedingly sold out. The percentage of stocks trading above their 50-day moving averages was darn close to zero. In fact, in the US, it got down to 6%. The percent of stocks with positive weekly price momentum got down to 4%. 96% of stocks had negative weekly price momentum. Percent of stocks making new highs versus new lows, almost zero. And the percent of stocks trading above their 150-day moving average or 30-week moving average, a longer-term measure of trend, got down to 12%. These are really low numbers. The only way we get there is if sentiment is rock bottom. The only way we get there is if positioning has become very defensive and everything has been for sale. We know the percentage of stocks in uptrends had fallen down to the low 20% range. So where are we today? Well, we haven't seen a reversal yet in bullish percent, but we have seen some changes in the short-term indicators. The percent of stocks trading above their 50-day moving average, both in Canada and the US, moved sharply higher in the last 2 days. Percent of stocks with positive weekly price momentum reversed positive and has begun to expand. And the percentage of stocks trading above their 150-day moving average also started to expand. So this is by no means something that is definitive, but it does certainly mean that something is changing. When we came in on Monday, we came in with a very defensive stance. We continue to be pretty defensive, but we've started to see some positive change. 2 up days in a row, including a follow-through day, is a great start. Some other things that we care about. Despite the fact that the S&P went right back to the lows, the percent of stocks making new 52-week lows is substantially lower now than where we were earlier in the summer. Same thing with the percent of stocks making new 52-week lows in the NYSE and in the NASDAQ. Those are bullish divergences. That's something that we care to see. When we looked at the sector work last week, we could see that all of the sectors were in small letters, meaning that breadth was deteriorating. When we look at things today, as of yesterday, oil was the first group to turn higher. Always important to see what is the last group to turn down, and is it the first group to turn up? Oil has led all year long. It's leading off the bottom over the last couple of days. As of today, precious metals sector reversed higher in breadth. Chemicals reversed higher in breadth. Steel turned higher in breadth. Machinery turned higher in breadth. Now, I think it's interesting that machinery, steel, chemicals, and oil, all economically sensitive groups, all reflationary assets, turned higher first. They also were among the last sectors to break down in this sell-off. That's interesting. It certainly doesn't paint a picture that we're headed for a hard landing. Also, that the banks and the regional banks stayed with the largest percentage of stocks in uptrends. Again, highly economically sensitive. They benefit from reflation for sure. These things don't say we're going into deflation or a hard landing. So let's look at the groups. Energy continues to lead, very quickly popping back up above both the 200 and 150-day moving average, started to move higher before the market made the low. And if we look at just a simple chart of the XLE ETF, which is a broad-based energy ETF, it's held trend beautifully over the last 2 years. Now, we know that the Strategic Reserve has been selling millions and millions of barrels into the market, trying to keep prices down pessimistically, or maybe in a suspicious way, leading up to the election. But we also know that OPEC is considering a cut of over 1 million barrels a day. So this is a positive change in the market. Certainly Brent crude reacted, and everything attached to energy did as well. This is the energy infrastructure group. These are pipelines primarily. AMLP owns a whole number of midstream energy assets. It has a running yield of just over 7%. It's been making relative strength higher highs all year long, and we're basically at a relative strength new high for this versus the market. We also have seen strength in solar. This is the early summer low. This is a higher low when the market was making its first low, and a higher low as the market was making a second low. This is a positive divergence. We also saw strength in other clean energy areas. But the bigger picture is more important. We talked about the fact that energy has been in a bear market for a long time. Solar outperformed through the energy bear market, but it was certainly impacted overall by the group. When energy broke out, solar well outperformed carbon-based energy, and the pullback has outperformed on the way lower. You see strong relative price performance since March versus the S&P. So all of the energy-related groups continue to show leadership, which is why it continues to be an important part of our portfolios. Another group that's pitching against the idea that we're going to have a hard landing. This is the regional banks, rising relative strength since March. We made a higher low while the market made a lower low, and very quick to rally off the lows, up well over 3% today. And the large banks up 4% today, making the highest relative strength reading going back to almost February of this year. Reflationary assets. Going back to the big structure on banks, we've talked about the fact that banks were in a bear market from 2008 through 2020. We broke out, and just like those metals, pulled right back to the long-term moving average and have consolidated, and so far holding in nicely, very quick to rally off the lows. My guess is bullish percent will turn higher for the financials tomorrow. Metals and mining, reflationary asset. The XME index is up 3.3% on a year where the NASDAQ is down 30. Relative strength has been rising through the year. Again, against the big structure. We broke out of a bear market. We pulled back to the long-term moving averages, and relative strength has been rising since March. Very quick off the lows, up 10% so far this week. Now, the other end of the barbell for us has been to have conservative assets, cautious assets, things that are not tied to the economic cycle that pay us a pretty good dividend. And the utilities are one of those groups. The XLU is down 4.5% on the year, well outperforming the S&P. Certainly was impacted right at the very end of the sell-off, but very quick to bounce. Same picture for consumer staples, rising relative strength through the year, very quick to rally, up nicely yesterday and today. So the dividend camp continues to act well. And of course, the healthcare sector fits into that picture. So the net of it is we're getting strength in reflationary assets. We're getting strength in the dividend camp, all of which outperforming the market, which makes a point. What parts of the market are not performing? Well, it's been largely large cap growth. But the dividend camp is doing well. Not only are dividend growers outperforming, and we know that since 1986, they've outperformed almost every other cohort of equities with considerably less risk, and that's been the case again this year. So going to those weaker sectors, I understand the interest in buying things when they're down. But so far, any attempt to buy dips has been a mistake. When we look at the IYW, it's a typical tech ETF. Apple, 18%. Microsoft, 16%. Alphabet, 12%. Meta, 4%. NVIDIA, 4%. Very high concentration in the largest companies. And these are the companies that have been having difficulty really since January of this year. At this point, we may see a turn, and we certainly had a good day today, but relative strength has continued to trend lower. No sign that there's a reversal here. Communications. Well, communications had a good day today, up 2.7%. Relative strength a little bit stronger. But certainly in this group, we have Twitter, and Twitter was up sharply on Elon Musk saying that he would honor his deal to buy Twitter. But again, no reason to be here. Now, we did cover some shorts yesterday in communications and technology. We don't have long positions, but there's really no reason to go long. Real estate, the same picture. So when we take consumer discretionary, communications, technology, and real estate, all are sectors that did well in a disinflationary world of low rates. The reflationary assets are not painting a picture of a hard landing. It may be that the economy is strong enough to withstand these rising rates and work through to the next economic cycle as we reset the supply chain. But we put our money where our mouth is. Financials make up 12% of our portfolio, energy 12, industrials 11.5. That's largely defense stocks. That's reflationary. Utilities, consumer staple, and healthcare are the defensive part of the barbell, and cash and government bonds give us lots of flexibility as things evolve. So I do think it's very possible we could have a very strong fourth quarter rally. We'll see, but it's a pretty good start. At this point, we don't see reason to add to consumer discretionary. We don't see reason to add to technology. We don't see reason to add to real estate. I do think we are likely to add more weight to materials if this market can find a footing. Our holdings continue to be pretty highly focused in Canada because the Canadian market has been outperforming. Outside of the US, Japan continues to perform well. This has been a wait for us for quite some time. We're trading almost at the high for the year, and you can see we came out of a structure that goes all the way back actually to 1991. Indonesia is outperforming sharply, much higher than the June lows in the S&P, didn't come close to retesting the lows when the market did. Same thing for Brazil, and the same thing for India. In our macro portfolio, similarly, we have lots of flexibility in the way of cash, but we have largely reflationary assets. And on the other end, some shorts in technology, China, real estate, and Europe. The newest position is we put a 10% short position against the US dollar. US dollar started to weaken versus the basket of world currencies. This is what's helped risk assets to rally. We'll see whether this is something that can follow through. Look, I think we are still in a structural bull market. We are realists. We don't fade this weakness. We have lots of flexibility in the portfolio to play defense, and we can play more if we were to break these lows from earlier in the summer. It is encouraging that some of the breadth indicators are turning positive. We know that positioning in the market is exceedingly defensive. We know that sentiment is in the dirt. We recognize October is a scary month. But having said that, when we look at what happens in the years where the 9 months that start the year are very, very weak, it tends to be that 3 months, 6 months, 1 year, 3 years, 5 years, and 10 years later, markets are a lot higher. Now, we talked earlier in the presentation about October of 2008. And yes, the next 6 months were difficult. But at this point, we don't see financial crisis. If we were looking at financial crisis, we would be seeing sharply higher credit spreads. In other words, the cost of insuring against default. This is what that looked like in 2008. This looks nothing like it at this point. So if the breadth readings roll back over, if credit spreads start to widen, if VIX starts to spike, if our individual positions that we own start to break on an absolute basis, meaning going down in price, or start to fail relative to the rest of the market, or if new leadership emerges, we'll reposition. But as it sits, I think the portfolios are in a good spot. We will not hesitate to get more defensive if we need to. We've shown that historically. But at this point, I feel like there's a lot that's been discounted into this market. And as I said earlier, to make binary decisions to go all to cash, I think is a very risky position at this point. We prefer to be balanced. So with that, Pamela, if there's any questions, we can certainly answer them.
Thanks so much, David. Yes, we have a couple questions here. Larry wants to know, David, energy used to make a much larger part of economic production and expenditure. If we go into a recession, does that mean that there will be less downward pressure on consumption than during previous recessions? Thank you.
Look, actually, consumption tends to stay pretty resilient through a recession unless it's a really hard landing. As we sit right now, the US has been pumping oil from the strategic reserves into the market, offsetting a deficit. That can't go on forever. The strategic reserves are getting low, and in fact, they're going to have to refill them. So I think that the supply-demand picture is going to be skewed to be tighter. Now, equities in general have only been discounting about $65 oil. As of today, Brent was back above $90. OPEC wants to see oil really between about $90 and $110. At those levels, these companies are printing cash. So, we follow our process. We did get stopped out of some energy positions over the last few weeks, and so our energy weight is lower. If they can find a footing, we can start adding some positions back. But I'm really, at this point, more concerned about there being a shortage than there being a glut.
Thanks so much, David. A follow-up question on that from Sebastian. He's asking, won't cutting oil production add to inflation again?
Yeah, I think that there's a mix of inputs here that are going to have an impact. The way that the companies are behaving that produce commodities, it's telling me that the market doesn't believe that commodities are going to get hit hard from here. They certainly pulled back over the course of the year. I think it is really hard for Fed policy to have a big impact on commodity use, especially when China is just starting to come back online. So I think that the backdrop continues to be pretty good for commodity producers because they trade at really low valuations. They're really underowned by institutional investors because they've been so out of favor for so many years. And politically, there are many institutional investors who don't own them because they can't, because they don't meet some of the ESG tests. I do think things like rents can be impacted by a weaker economy and certainly higher rates. I think that some of the supply chain costs can start to come out. I think that if they tighten enough to weaken the demand for labor inflation can come down some. But I think that hedge funds made a big bet that commodity prices would get hit hard, and they are not being hit so hard. They certainly are outperforming the S&P. So it may well be that this is just a pause in a larger cycle, and that we are going to get some follow through at whatever point the Fed starts to back off from their tightening cycle. Now, last week was interesting because central banks did show their hand. When the Bank of England felt that there was a potential for illiquidity in the financial system due to these pension hedges, they very quickly pivoted. I think that the Fed is ready for some pain in employment. I think that the Fed is ready to see some pain at the consumer level. But if they believe that the system is starting to freeze up, I think they'll pivot pretty quickly. And we saw that with the Bank of England last week. I think the market liked to see that because it made them feel that this tightening cycle may not be as persistent as the Fed is letting on that it will be.
Thanks so much, David. Well, that concludes the questions we've received this afternoon. And as always, I will leave you with the final word.
Look, all we can do is put one foot in front of the other, and we can continue to take new information as it comes. On the positive side, really happy to see some of the shorter term indicators turn higher. Really pleased to see 2 back-to-back strong days in the market. Really pleased to see our leadership groups really lead off the bottom and have held in better than the market through the most recent decline. We've spent a lot of time over the last few weeks identifying companies and sectors and themes where they are holding at higher levels than they did in June while the market went back and in fact made slightly lower lows. Those are positive divergences. So we got a lot of things in our farm team that we'd like to own. And I guess the point I would like to make is that despite the fact that we all worry about a lot of things, these things have been developing for months and months, and people have had opportunity to position for them. We're not in one of those moments where there's going to be some piece of information that takes everybody by surprise while they're overinvested. So I do think that the risk is that share prices close considerably higher at the end of the year than where we are now, but we're going to have to take it step by step. Thanks very much, Pam. Thanks everybody for tuning in. And if you got more questions, please don't hesitate to reach out either directly or via email. And we'll see you again next week.
Thanks so much, David.